So we're going to be talking about US money and monetary systems. So the topics that we're going to go over are money and money supply, Federal Reserve System and its functions, financial institutions, and how financial institutions create money. In general, money is an object that is portable, divisible, durable, and stable in value, and that serves as a medium of exchange, a store of value, and a measure of worth. So after President Nixon ended the gold standard on August 15th, 1971, the United States dollar became a fiat money, which in short just means it's no longer backed by gold. We have a modern current definition of money, which is M1, M2, M3, which are defined by the Federal Reserve. These we will go over in later slides. So there are three functions of money. So we have medium of exchange. We can buy products using money. We have store of value. We can save values using money for the future. And we have unit of account. Using money as a unit, we can record ins and outs and tell prices of goods and services. So we have M1 money, which includes all cash and coins in circulation, vault cash not included, amounts of all checkable accounts plus traveler's checks. It is called transactions money. People use this type of money for purchases you do at the grocery store, for example, and it is the most liquid form of money. So we have M2 money, which includes all components of M1, plus the forms of money that can be easily converted into spendable forms, such as short-term time deposits and short-term money market mutual funds. The Fed uses M2 to measure supply of money. So M3 money includes all components of M2 plus longer-term savings and investments, such as bonds. It is the least liquid form of money, and we only usually talk about M1 and M2. In the United States finance system, there's a central bank and many commercial banks. A central bank will conduct monetary policies, regulate, and help commercial banks. Commercial and private banks will receive deposits and supply money into the economy by making loans, which in turn creating more money. The Federal Reserve System, or the Fed, is the central bank of the United States, which acts as the government's bank, serves member commercial banks in the district, and controls the nation's money supply. So the Fed functions as the government's bank. They lend money for the government, but not in government's control. It also functions as the banker's bank. They lend money for commercial banks and acts as a lender of last resort. The Fed controls the money supply, supplying more or less money to control interest rates. So in this map you see here, the United States has 12 Federal Reserve districts. Each district has one Fed bank, such as District 1 has its Fed bank in Boston, District 2 has its Fed bank in New York City, so on and so forth. The Board of Governors, or the FRB, consists of 7 governors who are appointed by the president, and they have a 14-year term. The 12 Federal Reserve banks, one in each district, helps and regulates commercial banks in the district, in the map that we saw previously. The FOMC, or the Federal Open Market Committee, determines to sell Treasury bonds or T-bonds to increase interest rates or buy T-bonds to decrease interest rates. Member banks are commercial banks who have shares of stocks of the Fed, have voting rights for directors of the Federal Reserve banks. So the FRB, again, consists of 7 governors appointed by the president. One of the governors is appointed to be the chairman of the Fed by the president for a 4-year term. Should be approved by the Senate. Terms can be renewed within 14 years and determines monetary policies. So the Fed's 3 tools in controlling money supply. So we have required reserve ratio, which is a percentage of deposits that a bank must hold in cash or on deposit with the Fed. Discount rate is an interest rate in which the member banks can borrow money from the Fed. Open market operation is the Fed's sale and purchases of securities, T-bonds, in the open market. The FOMC decides what to do. The Federal Open Market Committee determines monetary policies of the United States. They meet every 6 weeks in Washington, D.C. 7 governors and 5 out of 12 district bank chairmen attend. Most important and often discussed in these meetings is about money supply and interest rates. So let's take a look at some important interest rates. So we have Fed fund rate, which is an interest rate charged on short-term loans, 24 hours, among commercial banks. The Fed can control the Fed fund rate by changing the supply of money. Discount rate is an interest rate on loans from Fed Bank to commercial banks set by the Fed. Prime rate is an interest rate applied on loans for best customers such as companies. The LIBOR, or the London Interbank Offer Rate, is a short-term interest rate in European countries. Works like prime rate in EU. 10-year T bond yield rate is a return on treasury bond with a 10-year of maturity, benchmark rate for long-term loans.